Hello again, I'm Anthony Newgrosh from BKL Tax. So, another month, another budget, and joining me today to discuss today's announcements is Chris Smith, Head of Personal Tax at BKL. Hi Chris.
Hi.
So Chris, would it be fair to say we dodged a bullet from a tax perspective today?
It's an interesting one, I guess. They're always quite interesting, but there were some major bits that we didn't see again. Maybe.
Such as?
We didn't see anything on inheritance tax this time round. We didn't see anything capital gains tax, barring one small tweak, which we'll come on to. But in terms of rates, staying the same. Pensions weren't touched. Usually it's a nice hot topic. Weren't touched at all. Non-DOMs. We thought there may have been something coming up with non-DOMs, but no, nothing. So fairly quiet from that front.
Okay, but there were some significant revenue raising measures. If we look at perhaps the three biggest ones, we've got the changes in the higher rate tax band, we've got fiscal drag, and we'll talk about that in a minute if we may, and we've also got the windfall tax on the major energy producers. So a month ago we were told that the 45% ban was completely going, Chris. What's happened to it now?
Yep, so it's back, as we knew from the first U-turn maybe, that it's not been abolished, so it's still at top rate 45%, but the threshold where you hit that rate has been reduced, and that's now down to £125,140.
Slightly random number, Chris, but there is some method to the madness. Where does that come from?
It's to do with the tapering of the personal allowance. So you would lose your personal allowance when you hit a certain number, and this number being 25,140 or 125,140, it will extinguish it completely. So it's brought us in line. We previously had tax bands that were in theory at the top rate of 40%, a 60% band, then back to 40%, and then 45%. And what's effectively happened is that we've abolished that second 40% band. So we've gone 40%, 60%, then 45%.
And if you include national insurance...
Yeah, of course, we've got a 2% hit on the national insurance as well. So it's still a sizable hit of tax.
So potentially 62% marginal rate of tax for certain taxpayers.
Correct. And the reality of this, I think we've touched upon it on previous videos that we've done, but this highlights it even more now, that you've got to start thinking about, if you're in that banding, what can you do to reduce back down to below £100,000? In an ideal world, I mean, that's looking at salary sacrifice, it's looking at pensions, and it means the net cost of doing that salary sacrifice or that pension contribution, it makes it beneficial to do. It makes it a low net cost.
Okay. And these changes take effect from when, Chris?
April 23 is when the actual changes come into effect.
Okay. All right, the second big revenue raiser is what we call fiscal drag. What do we mean by that?
So fiscal drag, essentially we have a rate of inflation, which we're currently about 11% we're at. So we would expect allowances and we expect other benefits to us essentially to increase it in line with inflation. But that's not going to happen. What was announced today is that there's a lot of freezes on allowances. So the personal allowance isn't moving. The basic rate threshold, when you start to pay higher rate tax, etc., that's remaining the same.
Until when?
So it's till April 28.
But not all of those allowances have been frozen, Chris. A couple are coming down quite significantly over the next couple of years.
Yeah, so we have a dividend allowance, which was at £2,000, and we've been told from April 23 that's going to reduce down to £1,000, and then from April 24 that's reduced to £500.
So that's the dividend allowance.
Yep.
There was also previously announced the 1.25% increase in dividend rates, and that was meant to mirror the equivalent increase in national insurance. Now that national insurance rate was cut. That 1.25% dividend rate is still staying, isn't it? So it's a bit of a double whammy here, increase in dividend rates and the reduction in the dividend allowance.
Indeed, and it's one that's conveniently snuck in there, which we know because they'd put through the national insurance legislation, which removed it from national insurance, and the legislation didn't go through for the dividends, so therefore it's a little bit stealthy that's stuck in there.
Okay. Now, similarly, we all get an annual CGT exemption. What's happening to that?
Correct. So where we said there's no major changes on capital gains tax, there's no change to the rate, which is good. It's still a relatively low rate of capital gains tax. But you get an annual exemption, which was set at $12,300 for the year. And we're being told from April 23, that's reducing down. So it's reducing down to £6,000 from April 23. And then it's going to reduce further from April 24. And that's going to go down to £3,000 from that date.
Okay, so there's still a window of opportunity though, isn't there? You can sell some assets now to use up your current year CGT exemption, and going forward, less opportunity.
Indeed. I mean, I think one where we see it noticeably for those individuals and for brokers that essentially do what we call bed and ISAing, which is where you're selling stock that you have off, utilising the annual exemption at 12,300 currently, and moving across to an ISA portfolio. That's just going to mean that it's going to be a slower drag to do so. I mean, the actual reality to these numbers that we're talking about, it's not, I wouldn't necessarily class it as huge sums. It's not high impact. I think from the capital gains, we're roughly £1,200–1,300 a year that could affect somebody. We've touched upon dividends. That ranges from £88 additional tax up to about 500 odd additional tax. So it's not huge numbers as expected. I think it can be a bit headline grab, but of course it has an impact. The physical drag is one that I think that's a little bit more effect because we're committing for quite a long time ahead to be stuck with what we have.
And as you say, with inflation at 11%, that is going to push a lot of people into higher rates inadvertently, as it were.
Indeed.
Okay, so that's fiscal drag. We've talked about the higher rate band. Let's talk a bit about some of the business tax changes now. And I think this is one more for me. Research and development tax credits. Now, these have been around for 20 odd years now. And currently, if you're a small or medium-sized company, you get an uplift of 130% on your qualifying expenditure. That's coming down to just 86% going forward. And if you're loss-making, previously you could encash your uplifted expenditure for a cash sum of 14.5% of your uplifted expenditure. And if you do the maths, for every £100 you spent on qualifying R&D, you get £33 back from the taxman. Very generous. Well, that £33 is now going down to just £19, so it's almost being halved. By contrast, for large companies, they get a credit under a completely different set of rules of 13% of their expenditure, albeit that credit is itself taxable. You couldn't make this up, Chris. But that 13% is now going up to 20%. So the two regimes are becoming quite similar in the benefits they provide. Looking ahead, we might find them merged in the future, given we're no longer encumbered with EU legislation that did restrict what we were able to do in that area. So that's R&D, and we shouldn't forget previous changes that were announced that are due to take effect from 1 April 2023, restricting qualifying expenditure broadly to work done in the UK. So all in all, this is going to have quite an impact potentially on the credits that companies can claim.
What about the corporation tax rate, Tony?
Corporation tax rate, you're quite right, was previously announced that it was going up to 25%. We were then told it was going to stick at 19%. We're now back, no changes announced today. That's going to stay at 25%, which is still relatively competitive. Okay, so that's R&D. There was also much talk in the build-up to the budget about possibly hitting landlords yet again. Now, there was very little in there apart from a couple of changes to stamp duty land tax. Just a month ago, announced an increase in the nil rate threshold from £125,000 to £250,000, and there was also similar relief, the increase in the first-time buyers relief band from £500,000 up to £625,000. Those increases are going to be cut back to where they originally were from April 2025. So they're around for another few years and should be taken advantage of.
We previously mentioned about some measures which weren't mentioned in the budget. Making Tax Digital is one of them. Landlords that are out there, we have already made you aware that Making Tax Digital is coming in April 24, and no change. It's self-employed as well. It's not just landlords. People were expecting maybe, or it was there, would it be delayed again? It's been delayed a number of times, but it's no change. I would, if you are unaware of Making Tax Digital and the implications of this, then I'd suggest please do get in touch, because it is quite a major change that's coming in.
Okay, thanks for that, Chris. Let's talk cars now. So, vehicle excise duty for electric cars. Yep,
it was one that was exempt previously. Now from April 25, we've got vehicle excise duty on electric cars. Been told that new electric cars from April 25 will have a first year charge, the grand amount of £10 for the first year, and then the second year charge it goes up to about £165, I believe it is. Current owners of electric cars from April 25, it hits, I believe, the standard charge, which will be the £165 straight away. So it is a little bit of an increase that's there, but the benefits of the electric cars are still there. The first year allowance for capital allowances for electric cars for the businesses that are out there, you've still got that incentive to purchase and get 100% first year allowance.
Yeah. Indeed not. So That's vehicle excise duty. Any tweaks on benefits in kind for cars?
We're slightly increasing. We've been told the benefit in kind rates are going up 1% for the next few years, and that will hit a top rate of 5% for cars. All other cars have the 1% band, 1% increase as well. Okay. I think, again, it is still incentivised to purchase electric car. When we go back to individuals and personal tax, that salary sacrifice we talked about, electric car scheme is still there. Therefore, the net cost of owning or buying an electric car through your employer, it makes it relatively cheap. And again, I think the employers out there, individuals out there, it's one to talk to us about. Yeah, there's leasing companies that we deal with. There's other salary sacrifice arrangements that you have to put in place, and we're happy to advise upon that.
Okay, so that's cars. This being a budget, though, there's always a bit of bated breath while we delve into the detail of what's announced and have a look at all those rather nasty anti-avoidance provisions. Now, there were very few this time. I think we'll just mention a couple in passing, in particular share-for-share exchanges. Now, there was a bit of naughtiness here whereby if you had shares in a UK company, you could swap those on a tax-free basis for shares in an offshore company, and you might do that if you were non-domiciled, because that could potentially take the value of those shares outside your estate for IHT purposes.
Indeed.
That has been blocked. We don't expect that to have a significant influence, but that was the only change in respect to share-for-share exchanges.
Yeah, I mean, we've seen that there's commitment to put more money to the revenue in terms of compliance checks and anti-avoidance, and targeting those high net worth individuals as well. Looking at the statement, there's a high expectancy of income for the revenue on this. So again, it's one just to be mindful of, that these inquiries, we may see an increase over the years because they're putting more resource into that.
Indeed, and there's also some extra compliance obligations for very large multinationals, but we don't again expect that to have significant influence. And Chris, that was pretty much it, I think, wasn't it?
Yeah, we normally say the devil's in the detail. I think it's one of your lines, and we've gone through the detail, and surprisingly, there's not too much behind it this year.
No, usual caveats, of course. This has to go through Parliament, there'll be a finance bill, and these changes can be subject to amendment, but always check in here and we'll keep you posted. So, overall reflections, Chris?
As we said at the start, we think it's a pretty quiet one. There's a little bit of stealth tax that's in there, and overall it's the delayed, it's the frozen allowances. It's what's going to be 6 years' time that's really going to be that impact. Hopefully going forward this will get inflation down. That's what we all want. We all want it come back into interest rates, come in at a lower level, get that inflation under control. Okay, so thanks for that, Chris, and of course any questions, do speak to your normal contact at BKL. Thanks for watching.
Thank you.